All of us want to maximize our returns from our investments. Nobody wants losses. Everyone wants high returns. But one must understand that with high returns comes high risk. So in this video, we'll try and explain the different investment options that are available for an investor. I'll also give a brief introduction about each of the investment options that I'm going to talk about so that you know what you're getting into. So let's get started. So first we need to categorize the investments into two main buckets. I've spoken about this in my earlier videos as well. The two main buckets are debt and equity. To help you recap, debt is a less risky form of investment where you get fixed rate of return, whereas equity on the other hand is a riskier investment option where there can be capital appreciation or depreciation on your investments. Returns are not guaranteed. So first, let's talk about the debt investment options that are available. So firstly, we have the traditional FDs concept, which most of you may be aware of. So what happens in FDs is that you invest in a fixed deposit, which is normally issued by banks, and the banks give you a fixed rate of return, either monthly or quarterly or yearly. Here, your principal is usually protected and you get a fixed rate of return. These returns can vary between 7% to 8% depending on the bank that you have invested in. The risk is extremely negligible unless there is a default risk and the bank closes down, which very rarely happens in a country like India. Frankly, I'm not a big fan of FDs, mainly because they only help you to preserve your wealth. They do not help you grow your wealth. The rate of return usually matches the inflation rate and the returns grow in line with the inflation of the country. Next, we have something called as the Public Provident Fund or PPF. So this is a long-term investment option to build a corpus so that you can use this corpus once you retire. So what happens in a PPF is that you invest on a regular basis to a fund which is maintained by the central government, and at the end of the year you get a fixed rate of return which is normally in the range of 7.3% to 7.5%, which is actually good when you look at it from a long-term point of view. Also, the returns that you get on PPF are completely tax-free. So there are a few points that you need to keep in mind before you invest in PPF. Once you invest in PPF, there is a lock-in period of 15 years and you cannot withdraw your money until the completion of 15 years. And you need to invest a minimum of 500 rupees every year to keep your PPF account active. I'm not going into too much details on PPF because the video will become too long. But if you do want me to, please do let me know in the comment section below. I'll make a separate video on PPF. Next, we have something called as the National Pension Scheme or NPS. This again is a long-term investment option coming under the purview of the central government. So what happens here is that you invest on a regular basis to a pension account, and after retirement, you can withdraw a portion of the corpus that you have accumulated over the years, and the balance will be given out to you as monthly pension. Investing in NPS also has tax benefits under Section 80C, and you can claim deductions and save taxes. Lastly, let's talk about gold. In many families, earlier and even now, people do have physical gold with them in the form of jewelry, gold coins, etc. And mostly, this gold is kept idle. So to turn this idle or unutilized gold into a more productive asset, there is something called as the Gold Monetization Scheme or GMS introduced by the Government of India. So what happens in GMS is that you can invest your idle gold into something called as a GMS account, and the benefits of doing that are, firstly, you earn a fixed rate of interest, which is normally 2.5% to 3%, which is way better than keeping the gold idle. And secondly, all earnings from the gold monetization scheme are tax exempt and you don't have to pay any taxes on the same. Now, if you want to invest in fresh gold, instead of buying physical gold, there is something called as sovereign gold bonds or SGBs as they are called, in which you can invest. They are a digital form of gold and they help you in the following ways. Firstly, if you buy physical gold, you need to pay GST as well as making charges. You also have to pay locker charges, which is an additional expense the more time you hold the physical gold. Secondly, on the redemption of sovereign gold bonds, you will not have to pay any capital gains tax. Thirdly, sovereign gold bonds gives you a fixed rate of return, which is 2.5% to 3%, whereas physical gold just sits idle. So we have spoken about debt investment options. Now let us move on to equity investment options. We can classify equity investment options into three main buckets. 1. Equity mutual funds. 2. Direct equity investing in stock markets. and 3. Real estate. First, let's talk about equity mutual funds. So in equity mutual funds, you invest in a mutual fund company which in turn invests in shares of companies. The equity mutual fund usually has a fund manager who is normally experienced in investing and researching the market. This type of investing is normally for those investors who do not have the necessary capabilities to research the market, or for those who do not have time to research the market. Second, let's talk about direct investing in stock markets. Here, the investor analyzes and studies the shares of the companies and invests directly in the stock market. I would personally not recommend this type of investing for those people who do not have the necessary capabilities and the qualifications to study and research the market, because equity investing is not easy. It requires a lot of research and in-depth market analysis. So you would be better off to invest via a mutual fund rather than investing it directly in the stock market. So only if you are well versed with analyzing the markets and studying companies, go in for direct equity investing. One alternative to this is something called as small cases. This is not a sponsored video. I have personally used small cases and it has proved very beneficial for me. So small cases is an app where you can invest in a basket of stocks. These basket of stocks are well researched by small case managers who are registered with SEBI. So using this will give you a feeling of directly investing in the stock market, but will also give you confidence that these are well researched backed companies that you're investing in. Lastly comes real estate. Investing in real estate these days have become extremely expensive. Investing in real estate requires a huge ticket size, normally in lakhs or crores. So real estate may not be for everybody, but however there is an alternative for this, which is something called as real estate investment trusts, or REITs as they are called. So REITs are basically companies or trusts which invest in office buildings, apartment buildings, malls, etc. So when you invest in REITs, the REITs collect money from you and they then invest in these kind of properties. The benefits of investing in REITs are as follows. Firstly, investing in REITs require a very small ticket size. You can also invest 500 rupees or 1000 rupees in REITs. Secondly, most of the REITs are listed in the stock exchange, so you can buy and sell stocks like how you do for other companies. So they're highly liquid in that aspect. Thirdly, the returns that you get from REITs are in the form of capital appreciation and rental income. So there are two types of returns that you can get from REITs. As of now, I think there are only 3 REITs in India. First, I think, is Embassy Park. Second is Brookfield. And third is Mindspace. I have not gone into too much detail on REITs, but if you do want me to make a detailed video, please do let me know in the comment section. I shall make a separate video on the same. So these are the different equity investment options that you can invest in. So that's it in this video. I hope you enjoyed it. Please do share your thoughts in the comment section below. Do like, share and subscribe to this video as well. I hope to see you in the next one. Thank you.